to this episode of the podcast. Today we have the pleasure of having with us Antonio Brina. Antonio is a managing director and the global co-head of Basic Materials Investment Banking at JP Morgan, including sectors such as building products and construction, paper and packaging, distribution, and others. Across both M&A and equity and debt advisory. Antonio joined JP Morgan in 2019 after spending 15 years at Bank of America Merrill Lynch and 3 years at Bain & Company and the Boston Consulting Group. He's originally a graduate from an alumnus of Bocconi University in Milan. And he has got an MBA with honors from the Kellogg School of Business in Chicago. Antonio, it is a real pleasure to have you in our show. Thank you for your time and kind availability.
Likewise.
Thanks, Antonio.
Thank you very much to you guys.
So, Antonio, maybe we can start with you telling us a little bit more about your journey and your work today.
Yeah, no, absolutely. I think, Paolo, you summarized it well. Anyway, I'm, adding a few sectors at JP Morgan from an investment banking standpoint, spending most of my time in mergers acquisition and equity capital market transaction in the sort of heavy and industrial sector, which is obviously like heavily impacted by the trend and themes that we are going to discuss today. On that basis, I'm happy to take more like a strategic industrial angle, but also thinking of the impact on financial markets that I'm seeing like on everyday basis.
Absolutely. And these are really the perspectives we wanted to discuss with you. And I guess, of course, the key context for this conversation is the evolution of globalization. And I would like to ask you to, from your perspective, what has changed in the recent years? How do you see, globalization affecting the evolution of the value chains today?
Yeah. So, long story short, this whole globalization is retrenching back massively as a fact. I was discussing yesterday with one of our research analysts that was mentioning that the word reshoring and nearshoring appeared like in the last quarterly results of S&P 500 industrial companies, like 2.5 times more versus the same quarter last year. So all the communication and reporting about the large industrial corporate, it's about this theme. And this is just accelerating. This has started like a while back, even when we think about trade dynamics between China and the US, which is the big theme today. In reality, a lot of tariffs were put in place already like long time ago. But then back from 2017 and 18, I think this trend of the acceleration on globalization has probably been pushed by COVID with manufacturing relocation to the global supply disruption stemming from the pandemic. And now the topic is exploding again because of the tariff discussion. But I would say this has been a theme for quite a while. We all grew up thinking of the world becoming more global, but certainly the trend has been reverting back massively for 10 years now for different reasons sequentially, and is obviously very topical these days because of the tariffs.
Yeah, absolutely.
Thanks, Antonio. One question more. So, if I understand well, totally agree with that. Framework, plan, source, make, deliver is gonna getting like closer and closer, and the production point is getting closer and closer to consumer like point, final point, right? So, in the global or regional, I don't know, tell us, supply chain perspective, which are the key drivers for the next years in your perspective?
Yeah. So certainly the easy and straight answer, reading the news every day today, will be tariffs, especially post Trump re-election. And I don't think we need to comment upon excessively because there is so much news flows regarding this topic. But I think there is something a bit more structural in relation to the reshoring, which is driven by the need of controlling production, logistic, especially post-COVID, but also value chain quality and sustainability. And key drivers is also the customer demand for certain specificity for certain product, but also the need to comply with regulation that is becoming more and more stringent. And obviously these are structural elements that started like pushing reshoring like a while back, and obviously they are exacerbated today by the tariff discussion. So on one side, there is certainly the government policy that is trying to boost local manufacturing and employment to tariff, but certainly we cannot ignore that ultimately corporate they want to secure like a more controlled, visible, regulated, sustainable supply chain. And this trend is here to stay independently from the policy discussion.
Let's bridge to the next question, and my main refer is about sustainability, which are, in this perspective, in these new kind of scenarios, the main drivers for ESG and kind of a sort of a green transition for supply chain.
Yeah.
Which are the most important drivers?
Yeah. So again, like on one side, it's regulation and policy.
Regulation and policy.
But I think the one that is probably longer term and there to stay are the customer needs and the requirement, the more stringent requirement coming from customers. And the two topics are becoming more and more interlinked going forward. And I think this is what is going to really reshape the type of offering, but also industrial strategy. So, and this was exacerbated again, like during the COVID period, we could argue because lower elasticity to inflation, better ability from people to absorb certain price increase. But as a matter of fact, like in a lot of value chain, especially if I think about the product I'm involved, like on everyday basis, talking to my client, there has been a trend of premiumization and more stringent requirement from the customer base to buy, to consume product that they are more sustainable, that they are sourced locally. And again, this is interlinked, obviously, with the policy and the regulation that they are forcing a certain change to be mandatory. But in reality, are customer preferences that they are driving also a lot of decision from this large corporate. The key question mark is on what extent the customer base is going to be able to continue to accept this shift toward more sustainable, premium, more expensive product, no? Because obviously we have been going through like a period of 3 or 4 or 5 years of very sustained inflation, where the boundaries were very blurry in terms of it's really true inflation or again it's premiumization of the product and customer requiring like more sustainable product. If the clock is going to stop from an inflation standpoint, are we going to go back to the requirement for volume, cheaper product and massive production? Unlikely, in my view, and the trend is quite well defined, especially if you put in parallel the risk of logistic, tariff disruption, and so on. In that sense, this nearshoring trends for all these different reasons, I think, should be continued like in a consistent way. Again, because of policy, but also because of customer preferences.
Yeah. And if I can connect, Antonio, to what you were saying about the topic of ESG being, of course, linked, to wider business topics, I guess it is fair to say that, part of the ESG conversation is compliance driven, but, there is another part of the conversation which is more strategic. But focusing for a second on the compliance driver. Of course, last week, I guess there were big news from the European Union with the announcement of the new clean industrial plan, which in a way is not, I guess, changing the objectives of the European Union concerning decarbonization in relation to the objectives that were set by the Green Deal. in terms of reaching 90% of cutting of emissions by 2040 and climate neutrality by 2050. But of course, the new plan is, I guess, designed to get there in a different way. Hopefully allowing economic opportunities and more competitiveness for the European companies involved in decarbonization. And then there was, of course, the element of the omnibus package, which was this a set of smart regulation, by someone perceived as a deregulation, because it kind of changed, I guess, some of the previous the proposal is to change some of the directives, and of course one of them is CBAM, that I guess is a topic for many of your clients. So just to stay one more second on this topic of ESG, I guess I'm curious what's CBAM means for your clients, and the type of reactions that you have experienced as a consequence of this change, not of objectives, but change of strategy of the European Union recently.
Yeah. So as a consequence, certainly a lot of companies, they want to reassess their manufacturing footprint and onshore or nearshore their operation, which again is the trend that we have seen in the United States for quite a while. And now up to Europeans to ask themselves the question. The challenge from European standpoint is before taking any very material strategic decision of shifting your production or acquiring, for example, like other industrial platform or locally like in Europe to reshape their supply, logistic chain and production chain, is on what extent you can define Europe as one country, one policy, and one market going forward. Because the reason why all this onshoring has been massively accelerated, like in the US in the past 5 years, adding 350,000 industrial jobs every year, relocating a lot of the production or so, it's because for a lot of the large US corporate, it was a sort of like a no-brainer. The policy is changing and tariffs are increasing, regulation is changing. I'm going to shift everything into my domestic market, and my domestic market is 300 million people growing like in a very healthy way. I can sell my product everywhere. The opportunity is huge. When it comes to Europe, the challenge is if I'm an Italian company, like a German company, a French company, do I really want to relocate production in order to control that value chain? What's the guarantee that I'm going to be able to be competitive by manufacturing plants across the rest of Europe or doing the same in Germany and Italy? This is where still the situation is very blurry in Europe because everyone seems still to take very independent decision and there is no common policy. Oddly, like in the past few days, for example, we have seen an acceleration from Germany taking their own decision and talking about massive investment for their industrialization in Germany and trying to push along like all the other European members to do the same. But it needs to be like a common decision, no? Following the same rule and certain rules, which is the discussion that Mario Draghi started end of last year when he was calling for an 800 billion joint plan, but making the point that all this investment needed to be defined in a consistent way across all the country to really give the incentive to people to change their strategy, their industrial strategy from one day to the other. So this, I think, is going to be a challenge to convince all the 30 participants of the European Communion to jointly move in the same direction and creating like one market and giving the guarantee to people that 20, 30 years from now, we are going to have one market, no? And there is not going to be like another Brexit and like in every other country pull out of the hedge, no? Which is the real risk and why the Europeans are reluctant to really pull the trigger on this nearshoring. In the meantime, you know what? In the US, the industrial employment continued to grow by like it was like 350,000 people per year. Now it's more like 500,000 people per year. And obviously these jobs are taken away from Europe and elsewhere, like in the world.
Yeah, absolutely. And let me ask you another question. So, of course, you have, I guess, seen, some of your clients taking this strategic decision to reorganize the value chain, to kind of regionalize their operations. And I guess we have discussed at this point, the strategic drivers of this type of decisions. Based on your experience, what are the, I guess, operational challenges when you basically start that process of a reconfiguration of your value chain? Any particular problems to be aware of?
Certainly so, because we are coming. Take the example of Europe again in general, not to make a generalization, but if you think about the entire continent has been coming from 20 or 30 years of deindustrialization. And the trend has been very consistent with all the attention and the education investment heading into the direction of just developing services business or certain type of technology, but very localized, and tourism and other stuff. So if suddenly out of the blue you decide that you want to go for like a massive industrialization plan, you just don't have the tools and the capabilities and to shift the direction so suddenly, because you need to be prepared in terms of education of people, motivation of people, immigration rules, authorization rules in order to set up certain like an industrial plant like in the middle of Germany, which is probably not possible in 2025 any longer, and to change like all this system is going to take a while. This drastic stoppage of industrialization, for example, was never faced in the US because then it's a very localized regional market and they continue to grow like in every market condition. Also because the immigration over time was so strong for so many years that just more like job and industrial job were needed and were like developed. And then in the US, now that we are facing this acceleration of industrialization, it's still possible to build a plan, to hire people. Also, the salary system is more balanced. If you look at what the blue collars are earning, like in the US, it's still very healthy, like in terms of a purchasing power standpoint, and there is still competition for that type of job, and everything appears to be very healthy to rebuild that type of structure. In Europe, I think is very, very challenging. Europe is not just as prepared and a lot of the country to absorb this reindustrialization and a lot of rules and a lot of policies that need to change very, very quickly, and some drastic action needs to be taken like in the near term to see any effect. But also considering local bureaucracy and different rules across, as I was saying, like from one country to the other, is going to be challenging also for anyone that is pretending to shift certain amount of production like into Europe to find themselves like in a competitive position to do so across France and Italy, for example. That's going to be wishful thinking in the near term, I think.
And of course, in this type of strategic projects of reorganization, you do have, I guess, many stakeholders with a vested interest and possibly, with influence. I mean, in your opinion, who are the most important ones, and what type of pressure they create on organizations today? Do you see, for example, more interest or pressure coming from investors or from customers, for example?
Yeah, I'm taking all the time financial perspective as an investment banker, and I'm going to talk about investors. Even though, I mean, to be fair, I started probably my discussion making the point that customers are really driving the shift in the supply chain, and the need to localize it more to improve the quality, sustainability, and control. But I think investors are dramatically reshaping the direction of travel of this type of investments. If you think about what is happening in the capital markets today, it's quite extreme. So we have been coming for 5 or 6 years of extra performance of again North American capital market versus European and emerging market at the exponential level. Meaning like extra performance in terms of not just stock exchange performance, but also M&A volume, amount of institutional debt, bonds raised in the capital market. So the America, it's much more fluid. It's plenty of volume of opportunities, and the flow is just totally different. Why? Because the amount of demand for investment there is totally different. So investors, they feel just more comfortable allocating money like in that part of the world, and pulling out from Europe, but also from emerging markets, no? Because they are so localized, a small market where you see a lot of more political volatility driven by the fact that there is no common policy. And obviously, when you start thinking of the policy of very small market, the volatility is increasing. While obviously, again, the US has the solidity of like a 300 million people market that is growing in a healthy way. And this is has been again shifting the investor demand more and more, allocating more money there, which is the reason why the spread in terms of valuation between everything is listed on the stock exchange in the US versus Europe is the widest ever. If you look at the price earning multiple, I think of the S&P 500 is 22, 23 times. If you think about the Euro Stoxx 600 is 14 or 15 times. So that means like on average, every US company is valued like 50% more. When you look at the M&A volumes, every single year that the mergers acquisition market has been contracting in Europe now for 5 or 6 years in a row, while it's been the opposite in the US, has been expanding over time. Why? Because there are like more strategic moves in the US. A lot of these US corporate, they found the capital to acquire like other business and also to sell off what they have outside of the United States. Obviously, more money means more investor demand, means more investment, more resources locally, more wealth, and is a circular reference that is bringing like higher GDP, higher growth, and then the valuation gap widening and marginalizing countries that they are not part of the game more and more. Again, challenge for European politicians and to sort of to break this and unlock this situation, which again is certainly like a big topic today.
Absolutely.
Oh, sure. So, Antonio, thanks for this super extensive and useful, like, talk to really understand, the whole environment here. The whole environment seems to be very fragmented depending by, the area we are. And depending by the area we are, the critical factors seems to be very different for these like supply chain restructuring and supply chain, let me say, reshoring, inshoring, or shifting these like dynamics. And I think you already answered, like for US and Europe, very different environments, so very different critical factors to keep in consideration. If we can you tell us about some some stories, some examples you lived or with your clients, you can maybe reveal or not, feel free, but very interested in to explore, some past stories you experienced in the last years.
Talking about my job specifically, I can tell you that even though I'm a European investment banker, I'm spending most of my time in the States. I'm going there like every other week. All the large corporate that I'm covering are following the same trend in terms of willing to deploy capital in that part of the world because this is what investors are asking them to do from an equity standpoint and from a debt standpoint. And they see a much stronger return on capital for any investment there, which means then healthier valuation, and is part of the circular reference that I was talking about. Specific point, Francesco, to your question, I can tell you that I relisted quite a few companies from London into New York. And again, this is public information. Company like CRH or Ferguson or Flutter, that they are all 30, 40 billion market cap. So we are talking about like a large amount of money. They reorganized themselves in such a way to shift to create a secondary listing in the US and then shifting the primary listing in the US, sometimes killing the listing in Europe because it was not so worthwhile and was not bringing enough liquidity. Working as well.
Yeah, that's what I see sometime on my end too. Yeah.
Working as well, like on a number of situations where for US clients, they are trying to quote unquote get rid of any non-US exposure, selling off their European operation, and vice versa, like also working for some European client, taking advantage of creating network density and like in their own country and buying a division from US company that they are retrenching back from Europe. But it's really reshaping the strategy. And even if you run any type of analysis and in terms of which companies they're really trading in the public market or in the private market at premium, are the one that they are strategically focused in one market and vertically integrated like in one market, which is the other dimension that we haven't talked about, like because it's not just like one geographical dimension where you need to be simpler, more focused, without pretending to manufacture like in one country and ship to the other, but it's also about vertical integration. So I see in my sector a lot of I don't know, the packaging companies are trying to vertically integrate into resins and upstream to have the full control of the value chain. A lot of the building product company regaining control of the distribution channels to make sure that the product gets distributed locally, but again, without pretending to apply the same standard in other country and to ship it on the other side of the world, because that world, again, is certainly unpredictable from a tariff standpoint, but also, local customer needs are becoming more and more local because people want quality, certification of the value chain, of the sustainability of the value chain. And this is becoming more and more of focus going forward.
And also, production meeting better of maybe fluctuating demand. So once again, like half an hour ago, plan, source, make, deliver, this framework to be at every step closer and closer, to the final market, as you said, I think. One other question, how your job like maybe evolved in the last years, which the most important, or, any lesson learned you want to highlight, you got?
Yeah, that the way my job evolved.
Personal question, for
evolved. It got much worse from a personal life standpoint because of the traveling. I can tell you guys again because it's I think good European banker is becoming more and more US centric. Lesson learned that you need to think globally on that basis. But again, it's a different concept, not because of the globalization, because of the opposite. Because tactically, you need to be flexible and taking advantage of opportunity to grow certain business and certain platform locally or relocate certain platforms and just be very, very creative because it's not just about creating large platform
on a big table
and as diversified as possible, but be as focused as possible and taking advantage of very specific opportunity for your client in very specific part of the world, developing the local presence, which is fun and challenging because everyone is adopting like a different strategy. But this is what really going to drive, I think, M&A, especially activity, but also capital market activity going forward.
So you're not moving around a big table, but maybe more across different tables, with different people sitting at the table.
Yep.
That's it.
And speaking of the future, Antonio, maybe the last question for today is, what is your vision for, let's say, the next 5 to 7 years? Do you see these trends remaining as they are? Do you see new trends or certain trends becoming more relevant? What is your forecast of the future?
Yeah, the overall trend of reshoring, nearshoring is going to continue in a very consistent basis and going even beyond the 10 years that they are talking about. The reason behind they are going to slightly change, which is the point I started from. I don't think it's going to be driven by tariffs going forward, which is what we are reading every day on the news, just because of Trump and the recent volatility and the back and forth, because that is a trend that likely is going to go away. And again, without making any political comments or what the impact could be from an inflation disruption standpoint, but it's not benefiting anyone, and it's just going to bring an excessive amount of volatility. The trend that is going to continue, and that is picking up again also on the back of tariff, is the control of the value chain from an industrial quality and sustainability standpoint. This is there to stay. Demand is going to become more and more differentiated locally. Customer client base, they are becoming more aware, they are becoming more selective, they want to be protected going forward from any change in regulation from their respective customers, and the closer they are to their supplier, the better knowledge they have of their supplier, the better off are going to be to succeed in the future. This is going to stay. This is going to continue going forward. I think people are going to be ready to sacrifice certain volume or that are too price sensitive and certain of their margin in order to internalize all these and improve control of all this. So what is this going to bring in practical terms? Again, more industrial jobs in every economy, and shifting a lot of the production from emerging market back to US is what we are seeing, but also back to Europe. When this is going to happen in Europe, I don't think it's going to be in the next 2 or 3 or 4 years, because again, you need that change in policy, and before giving confidence to a CEO to start building a plants in Europe, you need a lot of change in policy and a lot of comfort, and probably 2 or 3 years of people resetting their mind, rewriting laws, and then we are going to see this effect. But it's going to be a very long way, I think.
It's a longer shot. Yeah.
Very interesting. Antonio, it was really a pleasure to have you in our show, and thank you for sharing these very interesting insights from your work and vision of the future. Congratulations on your fantastic career and the good work you're doing. Thank you for being
Likewise for your initiative, Paolo and Francesco, and very, very nice to see you.
Thank you.
Thank you.
Thank you for listening to this episode. If you enjoyed this discussion, we invite you to like and share this episode on your social media. Enjoy the rest of your day.